if you analyze the boundaries, silver from here should go to $90 to $100 once we break out. And we broke out earlier this year. I think that's where it's going. Silver. Gold, at the end of the bull market, you expect to be 35 to 50 times the silver price, right? So if gold or silver goes to 100, gold goes to 5,000 at 50. If silver goes to, 100 at 35, gold goes to 3,500. I don't think that's a foregone conclusion. We're past that at this point. I think the numbers are much higher. I think the central banks gave us a head start.
Checkan, a seasoned voice in the precious metals world, recently shared an outlook that has investors paying close attention. His perspective on silver's momentum is both bold and rooted in historical patterns. According to him, silver's breakout earlier this year signals a strong continuation toward the $90 to $100 range, a level supported by technical and fundamental dynamics. He points out that this isn't just speculation. The metal's performance aligns with the shifting landscape of monetary policy and growing distrust in fiat stability. He also notes the traditional gold-to-silver ratio, where gold typically trades at 35 to 50 times the price of silver during a bull market's peak. Using that logic, if silver reaches $100, gold could be sitting anywhere from $3,500 to $5,000. But he suggests this cycle may surpass even those benchmarks. That the central banks, through their aggressive monetary actions, have essentially given us a head start. As the global financial environment continues to evolve, his message is clear. The groundwork for a historic metals rally has already been laid. The key now is recognizing it before the crowd does. Like, share, and subscribe for more market insights and precious metal updates.
Just recently, Goldman Sachs came out and they revised their forecasts upward. They think we're going to have $5,000 gold and $65 an ounce silver next year, up from previous forecasts. You've got Jamie Dimon, like I said, he's out there from Bridgewater. He's saying that everyone ought to have 15% allocation to gold. I think it took one or two to come out and make those bold claims in the traditional markets. I mean, for us in the alternative space, I'm like, what took you so long? We've been saying this for decades. But, for them to come out and say it, and now I think it's kind of like dominoes will start falling. They're not all going to go to 20%, but I do think they're going to find some room in their portfolio for gold. And I think we've covered this before. Average holdings worldwide in gold typically are about 2%. I mean, it's tiny overall. Of right now, prior to this surge in gold, we're looking at about 0.5% penetration. If we just, did 3 times what we're holding right now and move back to the norm, I mean, that would be massive for the gold market, let alone moving to 5 or 10, 15% in gold holdings. To be honest, I think, when we were down around $40 an ounce in silver and we were, somewhere in the mid to high 3,000s in gold, somebody asked me, who's going to get there first? Is silver going to get to $50 before gold gets to 4,000 or what? And I really thought because of silver's volatility, silver would hit 50 before gold did. And they ended up doing it about the same time, but I think gold won. So it got to 4,000 first. Now I remember saying, at $1,800, almost at all-time highs, gold is dirt cheap, silver's cheaper. And then at 2,400, gold is at all-time highs now. Silver is nowhere near it. Gold's cheap, silver's cheaper. $3,000 beginning of this year. Gold's at all-time highs, silver's not. It's gold's cheap, silver's cheaper. And every time somebody would come out and say, I'm waiting for the pullback. I think it's overdone and all this other stuff. The reality is nothing in the fundamentals suggested that it should go lower. Nothing in the fundamentals suggested it should not go much higher. And that's what we're getting. I've got about, 7, 8, 9 different indicators I look at for the top in a bull market for gold. None of them are firing. I look at the price. We're nowhere near where I think it should go, somewhere between $3,800 and $5,700 on a conservative basis, 2 to 3 times previous highs. The duration is nowhere near 10 plus years you would expect from a commodities bull market. Interest rates. to get people to dissuade people from buying gold, to rather have them choose term deposits at a bank, you've got to get a better return than what, 4.25 minus 3% inflation. That's just not going to get people's heads turned. So the real return is very low, and people would rather put their money in precious metals here. You need high single to low double-digit interest rates. You need a strong and strengthening U.S. dollar. We don't have that. The dollar is below 100 on the legacy index, and it's had a little bit of a push here lately, but that only gets it to 98. The dollar is weak, and I think we're in for about a further weakening. You want to look at the gold-silver ratio. It's got to get down to 35 to 50 to 1, meaning it's going to take 35 to 50 ounces of silver to buy that ounce of gold. We're just breaking 80, which signals the bottom and the movement upward in gold and silver prices, because investors now are finally investing. You want to look at sentiment. We're starting to see headlines, right? They're in the Wall Street Journal, Financial Times. You've got Jamie Dimon out there calling for 15% allocations, and others. I'm sure we'll get to that here in a second. But, so it's starting to get out there in the mainstream and people are talking about it. But my Uber driver is still not telling me how much money he made in the gold and silver market. So we're far from that. We've got a glimmer of hope with peace in the Mideast, but we still have a war raging in Ukraine. So we still have geopolitical crisis. We still have all sorts of domestic unrest in the U.S. and elsewhere. So all these things, the Dow to gold ratio, you got to get that down to 5, meaning it takes 5 ounces of gold to buy the Dow. We're at like 11 or 12 right now. So, we've got a long way to go. You need 3 or 4 of those indicators to fire to suggest, okay, the clouds are gathering and maybe the rain's coming. Time to look for the exits. We don't even have one firing right now. Don't be nervous about a top. If it pulls back, it's a dip in a bull market. Embrace it. Buy more well. I think London got in trouble in terms of their warehouse stocks when they shipped a whole bunch of silver to the U.S. ahead of the anticipated tariffs from President Trump, right? So they said, okay, the tariffs are coming. We cannot stop that train. Let's go ahead and move a bunch of metal to the U.S. so it's already there pre-tariff, and then we don't get hit with that, whatever the tariffs might be. And that was wonderful, and I'm sure it helped a little bit. But now the problem is they need metal in London, and they don't have it there. You're actually starting to see reverse flows of metal going back to where it's needed. I don't know that we're at a point where, the world is scrambling for ounces above ground. I know we had about 11 years of overproduction, and that was swallowed up in about a year or two of deficit production, but I still think there's enough above ground supplies to meet the demand, but it is picking up, and it's just, I think it's more of a matter of it's in the wrong place at the moment. I think, it's a weird cycle because this wasn't all investor driven, right? So this was central bank driven for 3.5 years up to this point. Normally we're looking at about a 10-year cycle for precious metals. I think this one's going to be longer. I think we're somewhere in that cycle of about halfway, maybe a little bit more. But I think the investors are getting in this later, and they will take it much further from here. What we haven't had really in previous bull markets is the central bank participation because of the de-dollarization, the hedging for inflation, and all the reasons that central banks have been buying. That was just like a nice head start, if you will, in the bull market. I think it really gets going now.
In a recent discussion, a leading precious metals expert, Checkan, shared his outlook on gold and silver's explosive potential as mainstream financial giants begin to catch up, with Goldman Sachs now forecasting $5,000 gold and $65 silver by next year, and major voices like Jamie Dimon and Bridgewater advocating 15% portfolio allocations to gold. The shift toward hard assets is accelerating. Historically, global gold holdings average just around 2%, but even a modest rise could send prices soaring. Despite gold's steady climb and silver's lag, the fundamentals remain strong. Low real interest rates, a weakening U.S. dollar, and persistent geopolitical tensions all favor further gains. Traditional bull market indicators suggest we're far from a top, meaning any pullback may just be a buying opportunity. Central banks have already fueled the rally, and now investor participation could take it much higher. Let's get into the interview.
We have politicians, and in the US, we're not the only ones, right? So we're having the same problems in Europe and Asia where we're addicted to debt. We like to spend more money than we take in revenue. And there's only two things that can happen at that point, Charlotte. Either you flat out default on your currency and your obligations, and that's the end of that currency. That's really the death knell for that economy, which is never going to happen, by the way, with the world's reserve currency. Or you do what I call death by 1,000 cuts, right? You do these little defaults all along the way where you expand the money supply. That's money not created out of any sort of, entrepreneurial activity. It's just out of thin air. There's more money in circulation. And all that does is put upward pressure on prices of everything that has any sort of value, because each dollar, each euro, each yen is just worth less, right? So a cup of coffee is going to be more, college education, new home, new car, an ounce of gold, an ounce of silver. So I think the world is waking up to the fact that to protect their portfolios, they need to get some hard assets, some commodities in there. I don't really see anybody addressing the problem, which is stop overspending. It's really not that difficult. They need to stop. And, Congress needs to do that here in the U.S. But I think the president has a hand in it too. He could easily just not sign anything that's not balanced. So I think that's got to happen. I don't see that wake up call yet. I don't think the alarm started ringing. The leasing rates are sky high right now to kind of tamp that down a bit, if you will. So you're going to see, again, premiums rise. I hate to pitch a product, Charlotte, but I'm telling you, we designed that Perth Mint program 30 years ago for the Perth Mint certificate program for the Perth Mint. We've had all sorts of silver squeezes in 30 years, and never, ever has that product been affected. It's 2.25% above the spot price for gold, silver, and platinum. It's been that way for 30 years without, a change. So, if premiums do get out of hand, there's no question where you should turn. 100%, allocated metal or unallocated metal at Perth, but 100% unique metal to you with a very low premium compared to what you'll find elsewhere. Now that the investor, the Western investor, but retail investors are getting into this market, they buy gold, they see gold at $4,000 and they said, that's a lot of money for 1 ounce. Maybe I should pick up some silver here. So we see a lot of that substitution buying going on. In both cases, that's putting additional pressure on a market that's already a bit strained, again, for having metal in the wrong place. So I think all of that kind of comes together and creates a little bit of a panic, if you will. And it's definitely creating a big run on silver. The biggest issue with silver, though, is, what I've always said, gold starts a trend up. Silver will eventually, once gold establishes it, will follow, and then it will outpace it to the upside. Gold will turn the corner to a bull market or to a bear market. It'll establish the trend. Silver will follow, and then eventually outpace after lagging behind. And it's really because of, gold is your leader. Silver is a follower, but it's a much smaller capitalized market. So when you start seeing the same dollars going into the gold market as they are into the silver market, the impact is bigger in the silver market.
In closing, the conversation turned toward the deeper forces shaping this entire precious metal story. And it's not just charts or forecasts. It's about a global addiction to debt and overspending, from Washington to Brussels to Tokyo. When governments print money out of thin air, every dollar, euro, and yen quietly loses value. It's not a dramatic collapse. It's death by 1,000 cuts. Prices rise, purchasing power erodes, and real assets like gold and silver become lifelines for those paying attention. As borrowing spirals and inflation bites, investors are rediscovering what hard money truly means. Gold may lead, but silver, smaller, tighter, and more reactive, often runs faster once the move begins. And as premiums rise, supply tightens, and retail buyers turn their gaze towards silver's affordability, we're watching the next leg of this metals bull market unfold in real time. The message is clear. The financial system won't fix itself, but you can choose to protect your wealth before the alarm truly rings. If you found this perspective valuable, Like, share, and subscribe for more insights on gold, silver, and the global forces shaping their future.